Hi everyone, this is Rob Roy of Elliott Options, and welcome to this edition of the U.S. Market Update. In the past, I used to do a recording series called Rob's Rants and Raves. Well, over the past few trading days, there certainly isn't a lot to rave about, so I'm going to shorten this one to just Rob Rants. Now, I want to make it clear that my intent here is not to be political. In past years, regardless of what political party was in power, I would simply analyze what policies were being made and how they affect the markets. And that's really all that we're going to do in this recording as well. Now, in the last recording, I had mentioned that I felt like maybe President Trump's tweet on the fact that they were adding more tariffs to Chinese goods could have been a little hypocritical when he came out the day before criticizing Chairman Powell, whose comments of potentially being a one-and-done rate cut had sent the market down. Well, then Powell clarified that wasn't his intent to say it was only one and done. The market was up 300, and then President Trump comes out with that tweet about the additional tariffs, and that reversed the market from being up 300 to down 300. And so since then, as you know, we've continued to go lower. So we'll see how this all plays out. The last recording was called the yin and yang of the market. Is the bigger picture here still going to be okay? Well, I also talked about the technicals and the fact that the market is so technically driven now, more technically driven than at any other time, in my opinion. And if you break the technical patterns, regardless of whether you think you're going to win in the end, then you have a lot of damage to recover, and maybe even if we get a rally on a trade deal, whatever, it doesn't bring the market back to new highs because it depends on how far down we go before we get that rally. You know what I mean? So everything is relative, and in this world of trading, nothing is more relative than Elliott in the charts. So let's take a look, and I'll continue my commentary as we go. But let's look at the charts. So here we are. Here's the chart of the S&P, and then here's where we had President Trump's tweet, and then we've gone down for 3 days since. Now, I've been saying that I felt like we needed to have a little bit more of a wave 5 high to bring enough retail traders into the market for the smart money, the shorts, to be able to reverse their positions, and then we have a more meaningful correction. And maybe that's not going to happen. Maybe this is going to be the end of it. Obviously, what's occurred has been unforeseen. So what happened overnight is China retaliated from those tariffs. And by the way, those additional tariffs do affect. President Trump's been saying that, hey, the American public's not paying for the tariffs. China is. Well, there's a lot of retail goods, etc., that are involved in these next round of tariffs. So they were seen as a little more harmful, potentially, to the U.S. economy than some of the previous tariffs had been. Well, then the expectation was, of course, China's going to retaliate. And that occurred last night at 9 p.m. We watched the futures. The futures tanked at 9 p.m., which is when China does their currency fixes, as they call them. So whether or not they're manipulating or not, that's just a matter of semantics, in my opinion. What they decided to do was not to support their currency and let it fall, and they let it fall to record levels. And when that happened, then that caused the futures to tank. We started to the downside. You can see we gapped down, and then we just continued to trade down, finishing near the lows of the day, just bouncing off a little bit. Well, then right after the close today, the U.S. government came out and officially labeled China a currency manipulator, a tag that they had not officially given China. They just talked about the fact that they didn't think it was fair the way they were playing with their currency, etc. And so that sent the futures down again. The Dow futures were down over 500 points not long after the market closed. The S&P futures were down an additional 40 points plus. But at the time of this recording, the futures are actually back slightly positive. So we'll see. China came out, didn't do anything else with the currency, but they did say that they were going to stop buying any agricultural goods from the U.S. That's the next step that they're taking. Now remember, one of the things that started this was President Trump said when he added these additional tariffs that China wasn't purchasing additional agricultural products, which was a thing that President Trump was trying to do to offset any effect that the previous tariffs may have had on the agricultural industry. And he said that China wasn't doing it or weren't living up to their end of the bargain. And so that's why he added the additional tariffs, which, by the way, apparently was against the advice of all of his advisors. He went ahead and did that. And now China says, well, we're not going to buy any agricultural goods. So this thing could get a little bit messy when you get into this kind of volatility. Got to be very careful. Now, whether or not this works in the end, and I'm going to give you, before we finish, actually a potentially positive outcome of this. It looks pretty ugly right now, agreed, but there is one potential positive outcome. You know, we did a recording called the Goldilocks setup, where the market was set up purposely or perfectly for a potential move higher in the market. All those things came to alignment, and it happened. There is one more Goldilocks potential scenario, but this one's a little more of a lower percentage chance of occurring, but it does occur. We'll get there in a minute. So here we are with where we are in the markets right now. And we've been very transparent with these recordings. If you've been following for the past year and a half, we've been forward. We're not doing back testing. We're not doing Monday morning quarterbacking. We've been right up front with what we're doing for our subscribers. So I wanted to share that with you as well. This is actually what was sent out to our subscribers today. Here's where we are in the markets. A couple things to take note of here. Number one, that green line, remember, is the 10-day moving average, and here's where we are, closing on those lows down here. So there's good separation here, which means we are way oversold in the markets. The next thing to take a look at is the fact that we have this gap that needs to be filled. So we have a gap there in the charts. Now, when that gets filled is anybody's guess, but that gap will be filled at some point in time. But look where we close. This is the key thing. Where we close today is right at the 61.8% Fibonacci retracement level. There's the close, dead on it. So with all that in mind, if we're going to bounce, this is a really good potential point to bounce. So we did send out an alert to our subscribers, little bit on the speculative side, but the potential is there for a bounce. Now, I want to be clear, this is not an expectation of the market running to new highs. We've got a lot of damage to fix, a lot of technical damage to the charts to fix before we can talk about new highs again. This is just an oversold short-term bounce potential trade. Now, it's easy to figure out where our stop loss would be if indeed the market does go down and trade lower tomorrow. If you come down to the 78.6% level, that nullifies this potential bounce, and then it likely means if we trade to the 78.6% level that we're going to retrace this entire wave 5 impulse, and that our new target would be down here to the wave 4, which would obviously be a downside target. At this point in time, there's a tiny chance, it's not a big percentage chance, but it exists, so we have to look at it. The fact that this could be an A wave impulse, then followed by the move down today being the B wave, coming down to my favorite level, the 61.8% level, setting up a potential zigzag back to the upside. Now, as I said, based on the damage that's been done, the percentage chance of that occurring, I think, is smaller, but it's there, so we have to take a look at it. So the possibility is that we then move into a new C wave. Now, it's probably going to be complex because we were pretty mono on the A and on the B, so likely the C wave would be complex, maybe some back and filling, churning a little bit, potentially back to new highs, but again, there's going to have to be probably some news out of Washington, some more presidential tweets, if you will. But let me give you quickly that potential Goldilocks bullish scenario, which could lead into this possible C wave move here. So I'm going to put the C there with a question mark because we are far from any sort of certainty of that occurring. But here's a potential bullish scenario. So follow me with this. Okay, President Trump's been critical of Chairman Powell for not cutting rates. Well, the Fed Fund Futures is now factoring in a 65% chance of not just a 25 basis point cut at the September meeting, a 50 basis point cut at the September meeting. Now, think about this scenario. President Trump, he was trying to play hardball with China. I get that. I'm not a big tariff fan. I've never been, if you go back and look at the recordings, I've not been a fan of the tariffs. Certainly wasn't a fan of this last one. I think we were winning. I think the president got a little bit impatient, felt like China's economy is doing much worse than ours, and the economic data clearly shows that. They're struggling with their economic data, and he felt like that he could press the issue here, and he had this opportunity. Plus, I think he was mad because he didn't feel like China was upholding their end of the bargain. So with all that, the additional tariffs come out, but it turns out the market didn't like it at all. But what about this scenario? What if, because of what's happened in the market, and the Federal Reserve did come out with a statement today saying they're monitoring what's going on in the markets, the Federal Reserve cuts, maybe they cut in August, at the August, maybe it's in September where they do 50, or maybe they do an emergency rate cut if things continue to look pretty ugly and dicey, and then that spurs the markets back to the upside. So what if we get a little bit of sideways move back in filling, then the Federal Reserve comes out with another cut? That could be a catalyst to move back to the upside. And then after that, after the president gets his way on the rate cuts, so we have the Federal Reserve cutting once or twice more, gets those 3 rate cuts that were factored in before, and then softens on China. They call this truce. They say that, hey, we're going to go back to talking again. Last time they did that at the G20, remember? That sent the markets higher. So there's your potential Goldilocks scenario of where things could move to the upside. So that's really the best case scenario for a continued move higher. And admittedly, the percentage chance of that is small, but it exists. And it's something to think about. It's something to consider. Little bit backhanded way of doing things, but the possibility is there. So let's keep an eye on it and see. But we'll watch this, and if we do trade down here to the 78.6% level, that scenario's off. The zigzag pattern at least is off. I mean, we could get the rate cuts in September, but we'd be starting a whole new pattern at that point in time. That would not be this C wave potential here. We would have to go down to this previous 4, and then maybe go through a little bit of backing and filling, and then start a new pattern. That would have to be a new pattern at that point in time. So I want to be clear, if we hit this 78.6% level, we're out of our short-term bullish trade on the market, and then we may trade to the downside here. This would be the target, and then at that point in time, you just sit back and you let the market tell you what it's going to do, and the Elliott wave will adapt. And this is what's, it's funny to me, I've said this many times, is that the thing that people are most critical of, I think, is one of the greatest powers of Elliott wave, and that's the ability for it to adapt or relabel, because the markets are dynamic, they're ever changing. We were headed higher, the market was up when the president sent out that tweet, and things reversed. Now, do you want a system that just says, I have no idea what's going on? Or do you want a system that's quick to adjust and adapt to what's going on in market conditions? And that's what Elliott wave does. So I really like that. So a couple other things that I wanted to show you here before we end is I wanted to take a look at gold real quick. We had mentioned this previously, but here's the latest consolidation in gold. We had a big consolidation back here for our subscribers with this big long descending triangle. We had a breakout there, and then as gold tends to want to do, or at least GLD, the ETF for gold, it breaks out, it consolidates, it breaks out, it does it all the time. Probably this, Google, a few other securities are the ones that consolidate and have their breakouts the most often. So we were out there. We didn't get this next move. We took our profits here at over 100% gain. So we took those, and then we continued up. We consolidated. And now we're breaking out again, and we do have another bullish strangle, or excuse me, another strangle in our volatility strategy on GLD. It's obviously an upside breakout at this point in time, but we had a gap up here in gold with that. We'll keep an eye on that as far as when to close this potential position out. But just wanted to show you that's what you would expect. Fear coming into the markets. And speaking of fear, let's look at the VIX real quick. Huge impulse to the upside. That's a little scary that that's labeled as an A, because what if we get a B correction here and then we get a C impulse to the upside for a zigzag on the VIX? Well, that means the market's going down. So that means that we hit the 78.6, we go down to the previous 4, and then all bets are off at that point in time. So we'll see how that plays out. But that's a pretty vertical move. Maybe that calms down, although the VIX goes vertical a lot. So it goes vertically up, vertically down. We'll see if there's more to the upside here. We already took out the highs back from May, and we'll see how that trades in tomorrow's trade, how these things line up. One other thing that I wanted to show you was TBT. We haven't looked at this in a while. The interest rates, it's crazy. Money moving into the bond market, pushing rates down again. Didn't think that we would necessarily see this big of an extension. It's rare, and the reason for that is because our wave 4 correction here was 38%. Dead on that fib level, dead on that 38% fib corrective level. So we had the wave 3 down, 38%. That means a 61.8% extension is your target. There was the perfect move down to the 61.8% level. We moved back up and tested the previous level, which is a good indication that you're going to go down to the next level and have an extended C wave, which we did. We had an extended wave down here to the 100%, and look how long we went sideways right there. Now, we didn't go back and test the previous level, which is normally your sign for a continued extension of a pattern. Now, we've already extended. 61.8% satisfied the pattern. 100% was an extended, see? And now, in this wave 5 and this big, huge C wave extension of the zigzag within this wave 5, we broke down without a previous test. So that's rare that happens. We're at 136% extension. Very well could see interest rates go down to that 161.8% extension. And again, that's a bit surprising. That's really, really extended to the downside on interest rates. So if you look at that, the fact that we're so extended on the way down, maybe that could be some fuel for that potential upward scenario that exists in the markets. But it's a mess right now. Well, we'll see how things trade out over the next few trading days. That's obviously going to tell us an awful lot. But I wanted to get back to you before a full week with everything that's going on and show you where the technicals were, where Elliott wave was in the charts, and what the potential scenarios were going forward. So you have the levels to watch both to the upside and the downside. Thanks for your attention. And if you like these videos, again, please give us a like, subscribe, etc. Enjoy bringing this information to you, and sure appreciate you guys taking time out of your busy days to watch. Thanks. Take care, everybody. Talk to you next time.